We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jonathan Mergott. He's the portfolio manager and precious metals market analyst. Thanks for joining me today, John.
Glad to be here. Thanks for having me, Tom.
So why don't we start off by getting a little bit about your background and the foundation that your grandfather and father started, please.
It was actually my great-grandfather back in 1957. This is currently what I do now. I'm the president and the director of it's a nonprofit investment trust. Essentially, we earn an income off of the investments that we make, and after expenses, the proceeds are donated to various different charities. Our focus really is trying to help the most vulnerable people in society. So we take a lot to focus on sick children, cancer funds, the Make-A-Wish Foundation, battered women's shelters. It's really, people that can't help themselves, some of the most vulnerable people in society. Prior to that, I was working with my grandfather and my father for an investment fund doing equity research, primarily in the gold industry and portfolio management. In about 2011 to 2015, me, my father, and Larry Roth were doing investor relations for Jim Sinclair and a couple other gold mining companies. My father and Larry had worked together for years in the 90s, representing a slew of precious metals companies, including Glamis Gold, which I believe was bought out ultimately by Goldcorp. One of the biggest and longest clients they had for a while was Impala Platinum. So over a period of time, I've been fortunate enough to be working with people that have had a significant amount of experience in the industry, as well as have met pretty much everybody there is to know in the precious metals industry. And I've been able to benefit from their experiences and meet some of those same people and benefit from the knowledge that they've been able to bestow upon me as well. So I've been very fortunate in that aspect.
Excellent. And the way I actually found you was you wrote an excellent article at the beginning of January here on January 9th that was called Riding the Gold Bull into an Algo-Driven Market Tsunami. So you kind of laid out 4 steps to really try and give people some perspective on what happened here. So, obviously we saw gold start off the year very strong and then saw relatively massive pullbacks. So why don't we start off a little bit by talking about step 1 and analyzing the fundamentals of the situation. So what's an important factor that most people are missing in their fundamental analysis right now?
Well, depending on who you ask, you can get a lot of different answers and people can tell you, and I've seen people that literally have an answer for everything when it comes to gold. Look at how well gold did during the Depression, during deflation. Look at how well it's done during inflation in the 70s and stagflation at the same time. We've gone up and we started going up prior to the financial crisis because of increased debt. We continued going up because of quantitative easing. In the 70s, you had high interest rates that were compounding debt faster, so that's bullish. Low interest rates in 2000 to 2011 that were very inflationary, and that was bullish. Depending on how you look at it, you can pretty much find a situation in which everything that happens is bullish for gold, which we know isn't the case because we've had bear markets for long periods of time. But when you really look at what has driven gold in each of those situations, deflation, inflation, quantitative easing, they've all been just symptoms of another problem. They're just listing symptoms of a sickness as opposed to the actual disease. And in every situation, it's essentially been people losing confidence in the system, be it either the currency, the economy, government's ability to manage the currency and the economy, or the stock market. How many people just exited the stock market after the financial crisis, vowing that they'd never go back again because they got burned so hard? I'm sure plenty of them actually are back again because it's kept rising, but they're back again after it's already gone up 400%. So I think when you look at every situation in which gold has had extraordinary runs, the main driver has been a loss of confidence. In the 70s, you had massive inflation, you had increasing interest rates, which is very different from what you have now. But at the same time, we had just severed in 1971 from Bretton Woods, We were not attached to the gold standard anymore. Gold was allowed to float freely. In a 10-year period of time, we went to $900 an ounce, and the dollar was collapsing. People were losing faith in the ability of the currency to be able to be maintained. In the Great Depression, you had a massive economic depression, and nobody was getting any relief there. The main driver has constantly revolved around a loss of confidence in the system, if you will.
Mm-hmm. So why don't we take a little bit of time and go through some of the other, let's say, fundamental problems with this economy right now that are really going to be creating a tailwind for gold. You mentioned that we had very high interest rates in the 80s, and there's, in a way, no option to be able to do that again this time. So why are some of the problems that have been created that we're not going to be able to fix this time?
Well, yeah, that's exactly it. We don't have that option anymore. And there's currently, $27 trillion in debt. We ran 3.1 trillion as our deficit last year. Prior to our new financial crisis that occurred in 2020, we were already pushing 900 billion, and that was before the recession and the pandemic. So we were pretty much just kind of like poking the bear there. I mean, even Keynes, said, that you're supposed to have surpluses in good times so that you can afford, government spending deficits in the bad times to stimulate economy. We've just never done that. So, I mean, $27 trillion in debt, we are fast approaching the point which even at very, very low interest rates, which the Fed is manipulating lower to try and push at the string and, stimulate the economy here, we're still closely approaching the point where just servicing our debt is going to be our biggest budget expense. 1%, 2% more breaks the bank. We can't handle it. You're going to start seeing our debt spiraling out of control. And, there are many that seem to think that this just isn't a factor that matters anymore. We'll see. This has been a very, very short timeline in the grand scheme of history that people have come to that conclusion. But the Fed stopped QE. Ultimately, people said in the last bull market, QE will never end. It ended for about 3 years, 4 years, something like that. We had 0% interest rates. We slowly brought them back up, down from 6.5% roughly in 2007 to zero, back up to about 2.25%. And then we had to panic them back down to zero within about 3 years. I mean, in the grand scheme of history, QE never ended.
Mm-hmm. And of course, you and I are talking today on January 19th. We saw Janet Yellen come out and say that interest rates are going to remain low for the foreseeable future. And she also said that the tax cuts that Donald Trump had put in aren't going to be repealed anytime soon. So there's no real way to be, let's say, creating any more money to pay down that debt by either of those two options kind of thing, right?
And wasn't that the case after Bush too? I would say I don't believe those tax cuts were repealed ever. So we just kind of dealt with that too. But yeah, and this is coming from the only person in almost now 15 years, I want to say, who ever raised interest rates. Powell got 2.25% raises in his career, and then he rushed them down. Janet Yellen was actually the only person who ever actually did it. Mm-hmm. But yeah, I have zero faith in the fact that some of these policies are going to be repealed. And I think I don't want to get too much into politics because I know it just alienates people. People will just, scream at you one way or another. But I see a lot of people there. They think because, the Democrats got the House, they got the Senate, they got the presidency, get ready for modern monetary theory, the Green New Deal, student loan bailouts, a universal income, Medicare for all this stuff. And I just, Joe Biden is not that guy. He just isn't. And I think, we're waiting for his stimulus package proposal. And he announced his proposal, $1.9 trillion. And he has a complete green light. Trump supported $2,000 checks to everybody. The House passed it. Multiple Republicans in Senate support it. Joe Biden has a complete green light for $2,000 checks. What is his stimulus proposal? $1,400. Mm-hmm. This is going to be the Biden presidency, basically, a series of disappointments of throwing $1.9 trillion into a void where it's not really going to do anything. And it's just going to be wasted money.
Mm-hmm. Yeah, that was just to kind of go back to my earlier point. There's no way to really do anything with that debt except for to create a deficit to pay it down. So why don't we move on to step number 2, looking at the technicals. So we've kind of gone over the fact that none of the fundamentals of the situation have changed. If anything, they're obviously getting worse. So what are the technicals telling us?
Well, I mean, if you're looking at some of the charts, now granted, a lot of gold and silver, the miners have been a lot weaker recently, but if you're looking more at long-term charts, this is nothing unusual. You're talking about very volatile assets and a market that is incredibly more volatile than it was just 10 years ago. So people are looking at these 10% dumps on silver. You know, it hurts. I mean, it hurt me, but I'm expecting increased volatility and increased moves like this, and that's what everybody should be expecting. And it's just something we're going to have to deal with. Every asset has increased in volatility and violent behavior in the last 10 years. In 2008, from the top to the bottom, the bear market took about 18 months and dropped about 65%. In 2020, we dropped 30% in 4 weeks. 4 weeks. And when you look at gold, though, we went from 1,700 right back to 1,700 in 12 days. So ultimately, you know, there was a lot of volatility there, but all you had to do was just walk away for 12 days and you would have never even known it happened. Mm-hmm. But looking at the technicals, you know, what I'm seeing even on, you know, some of the silver miners look absolutely extraordinary. And I think a lot of them are either breaking out to new highs and pulling back to their breakout points, which I think is incredibly bullish action, or you're having companies looking at a chart of First Majestic right now, broke out to its previous high in August from we hit highs in gold and silver, pulling back about 50% of the depth of that, you know, kind of bull consolidation. It looks like it's forming a perfect cup and handle, which is incredibly bullish above the highs that it had made from 2019. I'm seeing this across the board in a lot of different stocks. The GDX is probably one of the more lackluster charts out there that is still holding very, very well compared to what's actually, you know, been going on here. And we've been slouching a bit. And I think you can take some cues that from the weakness that there's going to be a little bit of weakness that continues. But there's nothing here that looks bearish or invalidates the bullish argument in any way, shape, or form. This is, I mean, once you get used to gold and gold and silver stocks, a 30% correction is just normal. That's just the way it is.
Mm-hmm. And do you think that this volatility that we're talking about, this is more driven by these trading algorithms, right?
It increasingly is a larger percentage of the market than it ever has been before. Mm-hmm. And I think we can see the evidence of that in the matter of speed. Like I said, the 2020 crash in March, 30% down, 4 weeks. You know, there was a large amount of people that were obviously selling, and there was a large amount of algorithms that were taking the momentum trade and just exacerbating it and taking, you know, a little bit of money at a time and making a profit. Mm-hmm. And this is, you know, we asked for this in the name of liquidity. And this is just the future that we're going to have to deal with. And this is why a lot of people have gotten turned off since the financial crisis in 2008 regarding the market, because they just think that it's an entire ridiculous manipulation. It's a scam. It's all rigged.
Mm-hmm. So, John, in the article, you mentioned that you like to watch the miners for clues as to the next move in the metal. So why do the miners typically tend to lead the metals?
You know, I wish I knew the answer to that question. I really do. But in 12 years of doing this, I can tell you I don't have enough fingers to count the amount of major clues that they've given. And here's an example. In 2011, I made a point of writing down the actuals of this. So gold ripped from 1500 to 1920, and that happened from December 2010 until August of 2011. Now, December of 2010, the GDX was about 64 when gold was 1500. 9 months later, gold had gone up nearly 30% by August, and the GDX had gone up 5% to 67.
Wow.
It was 9 months of incredibly frustrating action, wondering why, after a 30% move in the underlying, product that they produce, why with all their leverage, they weren't up an additional 100% from that. And then a few months later, when the bull market ended, you got your answer. They were underperforming because it was over. And it was frustrating at the time, but it was something to pay attention to. They're stopping their outperformance for a reason.
Mm-hmm.
And we can see another example of it actually just recently. Gold and silver, gold ripped up to 1960 in the last 2 or 3 weeks. And when you looked at the GDX, barely anything happened.
Mm-hmm.
For about 2 weeks, if you were paying attention to it, it was a little bit concerning. And if you were taking the clues from the past that the gold miners will give you leads as to what the metal is going to do next, that should have been an indication that the massive drop that we saw from 1960 down now about $130 to where we are at about 1830 something was a risk. So whenever you see, and inversely the same thing, if gold miners start ripping and the metal isn't doing anything, it's about to go down.
Mm-hmm.
I've seen that happen multiple times too. I don't know why they react prior to the metal reacting, but they do, and that's something that you can always count on if you're watching it. Watch the miners. They will give you clues as to what the metal is going to do next. They start going up for no reason when the metal isn't moving, we're about to get a breakout. If they start underperforming while the metal is rising a little bit, they're not believing the metal rise, and you're probably going to get a breakdown.
Interesting. So, John, can we talk a little bit about the price action of gold and silver here since the new year, and what are some of the important levels that you're watching for?
So looking at gold right now, we've got this little consolidation around the 1860 area to the 18 just on Sunday night. On Sunday night, very liquid time, the day before a national holiday, we get a really quick plunge all the way down to 1800 that oddly enough comes right back and has buyers buying it back up, and we end up basically perfectly flat. So that was an interesting move. But right now we're kind of going back and forth between about the 1860 and 1830 level. There's a Fibonacci retracement from the move from March, the 38% Fibonacci retracement from the low in March to the high in August. That is basically about 1844 that we're kind of struggling at right now. Above that, we're really looking at 1900, I think, on gold. I think that's really the line in the sand. Above 1900, it seems the bulls are firmly in control. Below 1900, it seems that the bears are in control, and we're kind of staggering a bit. So we start breaking above that 1840 to 1860 level. I think we make the run towards 1900, and then that determines who's really in control of the market. As we can see from just the past couple of weeks, we got to 1960 and then plummeted. And we did that prior back in November. And this was when the vaccine announcement started coming out right at that 1960 level. And we also plummeted from there. So this is clearly going to be formidable resistance around this 1960 area for gold. If we can break out of that, it seems pretty clear to me that we're going to retest the all-time high. Below this, I think our risk is, first of all, we had that spike low on Sunday night that hit about 1800 on the nose. Again, it was Sunday night at 6:35. Randomly, somebody decided to sell 2,800 contracts worth 100 ounces apiece of gold, which nominally works out to about $500 million. Interesting time to decide to dump your position. I think that level probably needs to be retested during a normal market hours when volume is actually there and people are paying attention. And the inverse of that would be just ripping away from this area and having investors say, no, that's too low, and buying higher. But there is the risk that we could retest that and also the November 30th low. and make a double bottom there. Silver, on the other hand, though, we actually bottomed back in September, way before gold, at about, I think it was a little shy of 22, but basically about $22 an ounce. We kind of retested that level around November 30th, and we've been significantly higher since then. I don't think we get back to that 22 level. I think we would bottom. If gold double bottomed, I think silver would bottom much higher than that. But the same sort of dynamics and levels I'm looking at here above 26, I think, is where we're looking at where the bulls start becoming in control of the market again. 28 is like the equivalence of 1960. We got slammed there. We got slammed there in September on silver. If we can push above 28, it's pretty clear that $30, the recent high, is the next target. And then we're looking higher than that. 35 would be the target after that.
Mm-hmm. So, John, what are some of the technical indicators that you use and any resources that you have found very valuable when trying to learn about these technical patterns?
Over the years, I've realized that cluttered charts just hurt your eyes looking at them. And so I've adopted the adage of real estate when it comes to, what are the 3 rules of real estate?
Mm-hmm. Location, location, location.
Yeah. And as far as I'm concerned, the 3 rules of technical analysis are price, price, price. Those are the best indicators. Price, price, and price. And I'll add in a 4th, sometimes volume, because, if the volume's low, it doesn't mean nearly as much as if the volume is 3 times what the daily average is. Mm-hmm. It clearly is saying what it's saying much louder. But no, mostly I'll look at, I use a exponential moving average. I'll use 10, 20, and a 39. And I'm mostly there. I'm just looking for crossovers that give an indication of a trend change, as well as massive moves higher or lower where you see moving averages start deviating from each other. That gives you kind of an idea of about how far things are going to deviate before you start seeing. If you look, at previous highs and lows, you can get an indication that things aren't going to move, 10 or 15% beyond these deviations before hitting a high or a low. And that can give you a little bit of insight into the market in terms of buying and selling. Other than that, really, I'm looking at consolidation areas for support and resistance and Fibonacci retracements and extensions. And that's pretty much it. Price, I've learned over the years, is the be all and end all. And that's really the king here. It's like I said, location, 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 price, price, price.
Excellent. So as we're trying to, let's say, play this from a more leveraged way by buying into the miners, do you think that they're still undervalued at this point?
Yes, actually I do. I think there's a lot actually, and I really do believe that in this situation, this is a mining opportunity. That was not necessarily the case in the bull market from the financial crisis. So when you look at some things, the miners from, say, 1990 to 2011 had ultimately about 6 years. From about 2005, when gold prices started breaking out above that like $400 cap that they had, to 2011 when they peaked, they had about that 6-year period of time to really gain on the gold price. And when you look throughout the past 20 years, these companies were basically used as a proxy to the gold price. Miners went up because the product they produce was going up. But if you look throughout the bear market and the bull market, probably the best performing 2 stocks were Franco-Nevada and Royal Gold. And the reason why is because they're royalty companies, and people started realizing the royalty model is far superior to miners. They have reduced risk politically to the geographical places where they're mining. They don't have to worry about increased costs or, political unrest. They have smaller, leaner companies. They don't have to worry about taxes, increased oil costs. Their costs in general have been generally pretty low. And, at the same gold prices 10 years ago, Franco-Nevada was 45 and now it's 120. Newmont was 70 in 2011, and now it's 60. Newmont's production has also increased since they bought Goldcore, and their costs since have gone down. I think in 2011, Goldcore's costs were in between on most of their mines about 1,100 to 1,300 when gold was, peaking at 18 to 1,900. So they brought that substantially down, and royalty companies have outperformed significantly through the bull market and the bear market. And it was mostly, I think, because people were buying gold stocks and it wasn't really a mining story. Right now, for all of the reasons that people were shunning the miners and hating the miners for the last 10 to literally 20 years, is all the reasons why I think they're incredibly undervalued today. And that even with the really good rises they've had in the last year and 2 years, is not actually accurately reflecting their value.
Interesting. So you were saying step 3 was to analyze your personal situation. So what are some of the considerations of this piece? And tell us a bit about how you think about them, please.
Everybody's different. There's a lot of things to consider here. You got to consider what you're doing, what your source of income, and do you have an emergency fund? If you were to lose your job, are you at risk of losing your job? Do you have a wife? Do you have kids? Do you have a mortgage? Your situation is totally different from somebody then that's single and, just living, renting and stuff like that. You got to analyze all of your personal situation before you're making any investments and things. And this is really what I've been focusing on recently, because I think people have been thinking that there's like a one size fits all. This is what's going up. So what I need to do is I need to go all in on what's going up, and then I'll be a millionaire. And that's not necessarily going to work for you or for most people. So you got to really kind of analyze. I said on Twitter the other day, if you're not looking at your own position and where your money is positioned and honestly analyzing the inverse of your position, then you're not doing honest analysis. You have to understand what your enemy's, game plan is. Hash out all the arguments, find which ones hold water, and then honestly, you can tally it up and see that you're in the right or if you're not in the right. Just because that gives you the conclusion that, junior silver miners are going to be the best performers in the next few years does not mean that if you've got, 2 kids and another one on the way and, you got a mortgage and, car payments and whatnot, that doesn't mean you should take every investable asset you have and go all in on junior silver companies and stuff that are going to swing up and down 10% a day. If you're the type of person that buys the extra rental insurance when you go on vacation and get a car, you might be a little bit too risk averse to these things. So, and there's no right answer for everybody. You really got to kind of look at yourself and do an honest analysis of yourself and, what you're hoping to accomplish and, your emotional state. And I've heard people saying it, they're literally losing sleep. They are literally getting physically ill watching their portfolios that they've saved up for a long period of time, and they're down 10% in a day. And this is not suited for everybody. Mm-hmm. And the name of the game here is there will be a payday. And what you need to make sure you do is get to payday. If you're going to lose your lunch, if you're getting physically ill, if you're losing sleep over your portfolio's fluctuations, the first step to take is try 10% cash. It's amazing how good it feels to know that you have a little bit of cash in your portfolio for when there's a huge unexpected turn and a dump, and you can buy, a little more of a position you liked or a position that you missed out on. It's an incredible ease of mind. Maybe you need a little bit more than that. Maybe you need to diversify out of just, all silver stocks and buy, Franco-Nevada and Royal Gold, some of these more stable, established, larger gold companies then won't go down 10%. I think they were down about 3% on Friday. So that mitigates the losses on your portfolio. If you have to sell, half of your portfolio and put it in Coca-Cola and the SPY so that you're at least not losing your lunch every day and thinking about selling everything and walking away, as long as you're there with half of your portfolio making 3, 4, 5 times your money on some of these investments, you're there for payday. And I'd rather see you do that than to panic and sell everything and end up not there at all. And there's nothing worse than being mostly right about a situation and having nothing to show for it.
So exactly how you're saying being mostly right about a situation, you had exactly that recently, and you wrote about this lesson of using leveraged ETFs. So can you tell us more about that too, John?
Oh, yeah. So the Fed started quietly trying to prop up the repo market in about November of 2019. We had a lot of what I found at the time to be suspicious things going on. Coronavirus at the time, COVID wasn't known. It just wasn't. The market had taken a little bit of a dip in, I think, early February, and then it rebounded. It was like, this is no big deal. It's like, I think this is going to be a bigger deal than people think. And I think, based on a lot of things, same sort of things I'm kind of a little bit worried about now. Over complacency in the fact that the market just keeps going up and you don't have to worry about a thing. Really volatile moves in some stocks. Like at the time, I think it was, Tesla. Tesla's been a constant in terms of volatile moves. But I think there was also, was it Virgin Galactic that people were jumping on? A lot of these things that everybody was just jumping on. And I was a little bit worried about that. So I bought an ETF that tracked the VIX. And I bought Dust because I had long-term gold holdings that I had purchased back in about September of 2018. And gold had been doing pretty well. And I thought we were going to have a liquidity crisis where everybody's going to rush for cash. The market was probably going to drop. Things were going to get volatile. Gold would probably drop with it. The miners would suffer the worst fate of both because they're both stocks and they're gold related. So they take it from two ends on there. And I thought this was the perfect situation. I would profit on both, raise a little bit of cash, and then I could swoop in and buy some of these gold stocks that I really liked at a lot cheaper prices.
And just to explain quick to our listeners, what is Dust quick?
Oh, Dust, D-U-S-T. Dust at the time was a triple leveraged short on the GDX ETF.
Perfect.
So what happened was gold started going up initially, then we crashed in the liquidity crisis while everybody was rushing for dollars, which was pretty much exactly what I was expecting. The market crashed. Everybody was just trying to get their hands on liquidity. And the VIX went soaring, made a lot of money on that. The problem was that there were such violent moves in gold and gold stocks. The GDX went from, where did it start at and where did it actually end? I think it started at about 30 and went all the way down to 16. So you're talking a 50% drop in a matter of days. Now, if something's supposed to track, 50% in a matter of days, like Nugget is supposed to track 3 times that, theoretically it's, negative something. So the functionality of these ETFs just totally imploded and ultimately get up right now. So at the time when it happened, I think on day 1, Dust had gone to 250. On day 2, it was 350. On day 4, it was 450. And on day 5, it was 100. So, yeah, sure. I had an opportunity for about 2 days to had sold for a profit. And then it just absolutely imploded. And then the company that issues the ETF, Direxion, announced that they were going to, we're not going to do 3 times. They can't track that anymore. So it's only going to be 2 times. And basically, like, the whole thing just lost its functionality. And I ended up losing as much money as I made on the VIX. So, I had called this almost perfectly and I had nothing to show for it. Luckily, I still had cash and I was able to buy some things while, some gold mining companies, Sandstorm, Royal Gold, Coeur d'Alene, Hecla, First Majestic, I was all buying as we crashed it. incredibly low prices. So that was still good, but I was hoping to raise my cash level further. And, the biggest market calamity in nearly 100 years. And I was 90% right and had nothing to show for it.
Mm-hmm.
Had I bought puts on the GDX, that would have been a different story. There's other ways I could have gone about this, and it wouldn't have, if I just hadn't messed with dust at all, I still would have had the profit from the VIX that I bought. There was different ways to have gone about this, and the problem was my execution. And, I remember watching the XIV blow up in 2018 where people lost millions of dollars. It went from 94 to 4 in a day. And this is the risk with, 90% of the time, you'll never have a problem. But that one time you do, you lose everything. It's not worth it. Don't use margin. Don't use leveraged ETFs. As long as you follow by that, the market can swing up or down as much as it wants. And you have all the shares you had before, nothing changes.
Mm-hmm. That's a very valuable lesson there, John. So what's step 4?
Oh, step 4. That's the part where you go fishing, isn't it?
Turn off your screen and go fishing.
Yeah.
And
as long as you're not using leveraged ETFs, as long as you're not margined, as long as you're not investing money that you possibly might need to spend on an expense in the near future, like your car breaks down, as long as you're not over invested and you're not losing your lunch and you're have conviction in a gold and silver bull market going forward that this isn't over. And I believe all of the fundamentals, all of the technicals, all of everything is showing us that this is absolutely not over. Then all you really need to do is turn your computer off, go fishing, as the saying goes. I don't actually go fishing. I recommend exercise. I'm actually allergic to fish, but I haven't been fishing in years, but to me, it's just an excuse to, have some alone time or hang out with a buddy and, kind of just enjoy nature and drink some beer. But as long as you're just getting away from your computer screen, it accomplishes the same goal.
Mm-hmm. All right, John. Well, let's talk a little bit about looking a little bit more forward here. We've analyzed the fundamentals, the technicals, the personal situation. What are your targets for gold and the gold to silver ratio and what that will mean for silver?
So ultimately, I'd really like to get a little bit of a more fine-tuned target on where we're ultimately heading. I think is going to be determined a lot by the next wave that we take higher. So I'd really like to see where we go on the next wave and where we correct to get a final target. But as it stands right now, I'm looking for about 2,400 on this next run, which I don't think is a ridiculous estimate. I think it's fairly moderate based on previous bull markets and previous runs that gold has had. I think the obvious target on a next run for silver is going to be $50 an ounce. If you're looking at that and doing the math at about $50 an ounce of silver and about roughly $2,400 to $2,500 an ounce on gold, that's putting us right about at a 50-to-1 ratio for gold to silver, which I think makes sense from where we are now, which is in the mid to high 70s. So that's what I think is going to happen on the next run. Ultimately, I'm looking for the gold to silver ratio to drop to about the 2011 lows, which was 30. Gold, I think a conservative and plausible estimate is about 3,500, which would give you about 117 on silver. The hard part here is we haven't seen levels on silver ever before above $50 an ounce, but I thoroughly believe that we are going to see triple digit silver. I don't think you can have $3,500 to $5,000 gold without seeing north of 100 on silver, which obviously is going to leave incredible potential with silver mining companies that currently have, costs at $15, $16 to $18 an ounce. It's just going to be absolutely tremendous. I think a triple digit silver is absolutely going to be a reality. Profit margins in miners will increase in the commodity bull market in general, But if we're looking honestly at $100 plus silver and say $3,500 to $5,000 gold, we have to expect costs to increase. But even if you're talking, say on silver, $30 an ounce costs, I still would expect that the majority of most miners, and there really isn't that many on the New York Stock Exchange. You got First Majestic, Pan American, Hecla, Coeur d'Alene, you got the SILJ, Endeavor, Fortuna, MAG. That's about it. I think I just named every major silver company there. You're looking at what I think is going to be five-fold increases on these when you really analyze at this point, I think First Majestic has been producing silver at roughly about $14 to $15 an ounce. Price of silver is about $25 an ounce. Versus about a year ago, their profit margin has gone from about $1 an ounce to up 1,000% from that. And in the meantime, the stock has gone, from about 5 to where it currently is at 12. So it's gone up about 150%. These companies still have a lot of potential.
Excellent, John. Well, I think that's a good place to wrap up here. A lot of good stuff and a lot of good perspective. And I appreciate being able to kind of step back and see the situation a little bit more for what it is. We'll post the link to the article that we were talking about in the show notes. And we can also find you at jmergz, JMERGZ, 1985 on Twitter. Anywhere else you'd like our listeners to find you?
Like I said, I don't write all that often. It's every couple of weeks or so I'll make a post, but there's alchemyfinancial.vze.com, which is my blog where I'll post articles that I write. From time to time, they get published in other places as well. But yeah, those are the two main places.
Excellent, John. Thanks very much for your time today.
Thank you very much. It's been great talking to you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.